I'm here today with Clay Larkin of PAC Capital, who helps us with all our portfolio management. And we thought we'd just do a bit of an unpack today and start off by just the Tuesday announcement by the RBA of just put interest rates on hold. What's your opinion or thoughts on that, Clay?
Yeah, thanks, Ben. And it's great to get on here and do this monthly update. And yeah, good time to speak given the RBA is keeping rates on hold at 3.5%. What is that? It was a split view from economists and markets saying, do they raise rates or do they keep it on hold? We've seen the US continue to raise, and what does that mean for us? I feel like from all the reports I'm reading and everything, that they're sort of looking like inflation is starting to ease and curb. We've got such a strong banking structure here, given what's been happening in the US, which is a hot topic that you and I speak about a lot. You know, for us in Australia here, I think that them holding the rates on hold for the moment is an important sign to sort of show that we're in quite a strong. There are still some cracks, which you and I talk about a bit, but Australia's economy as a whole is in a solid position, and I think that reconfirms it today.
Yeah, so where do you see, so I know a few big building companies have gone under recently. I just wonder, one, has that had a bit of an impact on the decision? And two, how do you see it playing out towards the end of the year? Do you see it increasing a little bit further, or do you see it being relatively sustained where it is?
It's a good question. I think that there's been such a rapid, 11 rate hikes in a row. It's okay to sit back and just breathe for a minute. All my sort of readings on the RBA website now is that they're saying, let's just stop and breathe and see what happens here. Because I was even talking to Mark Boris the other day, and he was saying it's a big lag effect, because obviously he's involved with mortgages and Yellow Brick Road, saying that when they raise rates, it doesn't actually kick down into people's pockets or the economy for 3 to 4 months after. So you're just starting to get this big lag effect that's starting to happen, and we don't really feel the effects on people's wages and pockets just yet. So I think they're going to pause for the next quarter, at least till the end of financial year. And I do still think that there are some red flags on the horizon for the end of the year, but they could easily try and stimulate the economy too at the back end of the year, Ben, and cut, So for me, I think this is sort of in the Australian market. I think there's still a bit more to go in the US, but Australia, I think they could raise 1 or 2 more times, but I feel like we're at the peak and it could plateau from here.
Next point, there's been a lot of talk around banks, Credit Suisse failing and Silicon Valley Bank, and do you see that as, often we see that as a bit of an end of cycle sort of happening. How do you see that filtering through to, is it going to be just exactly what it is, or is it going to filter and become a bigger thing, do you think, around the banking sector?
Well, it definitely shocked me. Okay, I was surprised when I actually have a fair bit of connections into the US market, and through a lot of my investments and a few different structures that obviously DMG are a part of, especially in that PP1 fund that's been a recent addition to the portfolios. That has definitely an influence into the Silicon Valley banks and other banking structures in the US. Now, the reason I'm talking about this is it surprised all of us, the fact that such large organizations around the world have essentially fallen over. And that gives me and my team and all of us some concerns about what fundamentally is broken on the inside, and how did not only regulators miss it, or how are they printing so much money and lending it in a way that causes a bank to fall over. That sort of, in my mind, shouldn't happen in 2023. What does that mean? It means that I still think that there are financial fractures around the world. Do I think another GFC is coming? No. But do I feel like, as you said on before, there's not only banking fall over, but there's also building companies in Australia falling over. These are things that are starting to snowball a bit more than I like.
It's interesting, your comment around how does this happen in 2023, but banking failures are pretty common, aren't they? Like, the peripheral type banks, they're sort of happening all the time, and we just don't hear about them, do we?
Yeah,
So,
and that's right. And even as the US comes in and puts a backstop against these banks and supports, like, again, they print more money, Ben. And keep bailing these structures out. We're in unprecedented times here that hasn't been seen before. Through COVID to where we are now, and I've never had my eyes as open to the economic situation in front of us than I have right now. It's interesting times.
Is there anything portfolio-wise that you feel that we're doing to sort of, take advantage of that situation, or reduce volatility through that period?
Yeah, the portfolio has always been pretty structured in quite a defensive way. Not so much in a defensive way to say always looking at doom and gloom on the horizon. It's still capturing income and growth, but doesn't have the volatility as being so exposed to risk sectors or equities as such. So how are we positioning portfolios right now? And a question you touched on before was, yeah, we were a bit more optimistic at the start of the year. At the back end of last year we were. But we have at UnPAC Capital and throughout the portfolios, we have, which Ben really well, that we have these internal risk systems which we input data in there weekly, and it identifies risks or cracks in the portfolio that are fundamentally causing that we should make changes to the portfolio. So in February this year, when there was a higher inflation print than we wanted, this PRS system, or the PAC risk signals, actually went from 1.05 to 0.98. And that doesn't mean anything to anyone, but that actually means for us, we need to start to take some risk off the table and go into some more defensive fixed income style scenarios. And we did that within the week. So trying to be nimble, trying to be proactive, not reactive in this environment is really important. And I can only talk about that because this morning on our investment committee meeting, Ben, when we identified and spoke about all these topics, and we were trying to find assets over the last 6 months that are more uncorrelated to equity markets, more taking investments away from, something that we see on the news that the ASX is down 5%, that doesn't necessarily impact our portfolios as much. But we have gone into asset classes such as high credit or duration, and it seems like we laughed about it on the call this morning, but we do speak about this fixed income a lot these days. And what does that mean for portfolios, given where interest rates are now? This is a conversation that seems you and I have weekly.
We do. Thanks, Brian. I think it's a good little wrap for the month. And, lastly, just being a Sydney rugby person, just your prediction for now the start of footy season. Who's going to win the AFL?
I had a feeling this would come up after us planning on going to the Wallabies in the mid-year, and that I'm a rugby guy, so AFL is not my forte. But I tell you what, I'm from Sydney. I've probably been to a handful of matches, and I can say that on the call here. Don't make that against me. But the most matches I've seen is actually in Adelaide, and so I actually saw the Adelaide Crows and Richmond last weekend with the group there. So I'm going to actually say my most followed team would be the Crows. I don't think they're going to win, but I reckon they'll make the 8 this year. So.
Appreciate it, mate, as always, and look forward to it.
All right, thanks, Ben. Cheers.